Good evening, everyone. Welcome to the quarterly investor meet for discretionary solutions. Before we begin, let's have a look at the macro picture in terms of how the situation is evolving domestically and globally. India's macro fundamentals remain strong. There is a possibility that a potential US trade deal with India and the other countries will be probably struck soon. There's a lot of posturing in play, but what we believe is that this will not have a large overhang for the markets. The markets are working with a base case that possibly sooner there will be some negotiations that will transpire and we will have deals work out soon. The earnings season that is underway right now, we have had an okay start to it. The markets are not expecting the earnings to be too great. So we are going into the season with some amount of circumspect behavior from the market, which in a way typically works out better if, let's say, the earnings turn out to be slightly negative. That is what the markets are any which is expecting. Any positive surprise can be a welcome change, and the markets look to quickly price that. We expect that financials, capital goods, and mid-cap pharma will play out better over the coming 12 months. We expect the government spending to remain pretty robust. We have seen a decent amount of pickup on this side over the last 5 to 6 months. The monetary policy has seen a sea change, both in terms of action and stance from the central bank. This, with the monsoon season, which looks to be slightly ahead of the average at this point of a time, augurs well for the coming quarters. Higher valuations in terms of the long-term average, probably a lot of the papers which is hitting the market. What we are seeing at this point of time is the promoters are diluting a lot of stake at this point of a time, so the supply remains very, very high. These are some of the things which could be a slight overhang, but there's enough liquidity available. So there are enough flows from domestic investors or foreign investors to absorb all of these papers which are coming through the market. The geopolitics remains an overhang, but yeah, this is becoming less and less concern for the market. The macro fundamentals domestically or globally have remained pretty robust, and equity markets, not only India, world over, have taken cue from that. If we focus a little more in terms of the global trend, I think it's the US has kept everybody very interested, either in terms of the actions, tweets coming from President Trump himself. What has also happened is with the high debt levels which the US economy has been seeing, the dollar has been under pressure. In fact, the US dollar has had one of its weakest performance on a 6 month basis the start of this calendar year since 2000. So it's been almost a 25-year kind of trend which has got broken, where the dollar has corrected. Uh, Whenever this happens historically, on almost every occasion is when the riskier asset classes have tended to do well, which would include, let's say, oil or equities world over. The dollar index at this point of time, being 10% lower, has had that same kind of an effect on the equities world over, where global equities have done well, including India. Though India has trailed a bit as compared to global equity, we expect this to continue. There's no reason for the dollar to inch up from here on. So, with this environment works in favor of the riskier asset classes from the next few quarter perspective. We expect the economic activity in India to accelerate in the second half of this fiscal year. We have noticed that the recent GST collections showed a slightly tepid trend, but that was expected with the kind of slowdown which we had seen in the probably a couple of quarters back. But the GST collections are more of a lagging indicator. If I focus a little more in some of the leading indicators going forward, there we see a robust trend possibly coming through, where the manufacturing and the service PMIs are showing a very, very healthy trend, almost at multi-month highs. Taking cue from this, where the earnings looks like that this quarter will bottom out, the leading indicators looking better. From an economic number perspective, we could be getting into a slightly better 2 to 4 quarter kind of an outlook. From a valuation perspective, Indian markets have bounced back after the kind of volatility that we have seen in the month of Jan-Feb of this calendar year. But March onwards, the market have rebounded quite a bit. In spite of that, the Indian equity markets have trailed the global peers. So in spite of the Indian markets moving higher, the India's relative valuation as compared to global peers has in fact corrected. This is important because over the last couple of years, the domestic flows had remained robust, But concerned by India's relative expensive valuations versus global peers, FIs had been moving money out of India. But this, possibly from a valuation perspective, seems to be changing, where India now is relatively much better poised as compared to it was probably 6 or 12 months back. In line with that, we have seen some amount of return from the side as well. If I look at more action from the central bank, not only we have seen a change in stance across the board, RBI has taken a lot of measures. The interest rate cuts definitely one of them, but apart from that, they have taken a lot more measures to improve the liquidity in the system. That remains an important parameter because if we look at around October to December 24, that's when the liquidity in the system was extremely negative, which had impacted the overall economic activity. But RBI has quickly changed stance, where not only action on terms of the rate side, but they have addressed the liquidity issue as well. RBI stance continues to be supported by the inflation numbers, which have shown a downward trajectory, or inflation has remained pretty benign at this point of a time. Inflation has not been a worry for RBI, which has enabled them to shift their focus back to the growth aspect. And they have acted in terms of getting the liquidity and interest rates much lower. This should again augur well for the couple of next quarters in terms of the economic growth, which could bounce back. Let's focus a little more in terms of the overall valuations for the equity markets. How we are reading the markets is at this point of a time, uh, the overall market, if I look at, is not in an expensive zone. Yes, markets have bounced back. The valuations are also slightly more richer as compared to what we were 6 months back. But in spite of that, the long-term valuations, both on price to earnings and price to book, are below the last 10 years average. So from that perspective, the markets are not in an expensive zone. They may not be cheap, but in spite of the bounce back, still the markets look decent from a valuation perspective. Looking at large caps separately, large caps on a valuation side also look in a comfort zone at this point of a time, though the valuations have meaningfully improved or got expensive as compared to last 6 months back, what they were in January of this year. On the mid cap side, the earnings momentum over the last few months has been much better than in terms of the catch up on the valuation side. So, though mid caps have also bounced back over the last 6 months, but from a valuation perspective, they're still much closer to their long term average. This is largely supported by the earnings numbers, which has been better than the large cap peers, again on the mid cap side. India versus global, and this is an important parameter because FI flows coming back could again support the market big time going forward. There, if you look at Indian equity markets have trailed the global equity markets over the last 12 months, which is now reflecting in terms of the valuations as well, where Indian markets look from the valuation is at a lot lesser premium as it was probably 6 or 12 months back. So Indian equity markets are becoming a lot more attractive from a foreign institutional investors. The same trend is reflecting if I look at in terms of the MSCI overall valuations, where it is below the long-term historical average, which India has typically traded at. In Q from this, what we keep doing is we look to adjust the allocation across our different funds, where as an outcome of the various models, frameworks that we use, we see at what point of time how much risk you want to keep in the portfolio. So probably around 6 to 9 months back, we were in a risk-off mode where the allocation on the active side of the portfolio was around 60 odd percent, which over the last 3 4 months we have increased to around 71% of the portfolio. So in line with our view shared in the last quarterly update, we had also sent out a note to all investors in the month of March that what we were doing is we are altering our stance in terms of the portfolio positioning. We were looking to add risk back, which has worked in our favor. So around March 25 is when we added some risk back to the portfolio by increasing the active allocation within our funds, which has coincided with the bounce back which the markets have seen March onwards. Uh, A summary of the overall framework that we follow on various parameters, if we look at, the framework is indicating that we are seeing some amount of improvements across the board. So there are no red signals at this point of a time on any of the parameter, but on couple of them, if I look at in terms of the overall flows, the domestic flows have remained robust in spite of the market having a volatile period between Jan and Feb. It was possibly thought through that that this was the sharpest correction that the markets have seen over the last 4 odd years. Possibly it will lead to some amount of nervousness among the investors, especially the retail community, but that has not really played out. The flows on the domestic side have remained very robust. The SIP flows have remained very strong and keep getting stronger on a monthly basis. In fact, on the flow side, we have seen some improvement where the foreign flows have turned much better. For a long while, the FIs are pulling money out of India, but now we are seeing some amount of reversal on that side as well. That's why we see some amount of positive development on that parameter. On the liquidity side, especially the measures taken by the central bank have been a big influence in terms of the liquidity position improving in the overall system, which is aiding the bounce back in the economic activity in the country. So there, if I look at from a very, very high deficit zone on the liquidity side, it has quite sharply reversed. So that's why we are seeing that the liquidity side is also becoming more supportive from the economic perspective. Otherwise, on macro fundamentals, we are seeing it remain pretty strong from an overall perspective. In fact, the fiscal consolidation which the government has outlined has been a big enabler uh, in terms of the macro fundamentals remaining quite robust. So there, the framework continues to indicate that at this point of a time, we can have a more positive, nuanced view on the equity, positive view on the equity markets. In line with that, over the last 3 4 months, we have added risk back to the fund, and the equity markets also have rebounded. Over the last 3 months, what we have seen is a sharp reversal in the market after the volatile period of the first couple of months of this calendar year, where the broader market has bounced back more than the large cap names in the equity markets. Also, what has played out is a quite of a reversal, where this year now it's been more of a bottom-up kind of a market, where if we look at, there's been more alpha in terms of directly identifying stocks rather than following some index-linked passive allocations. This has also coincided with us increasing the active allocation back in the portfolio around March of this year. Uh, we also reduced the low vol strategy allocation in the fund around March, which also worked in our favor. Jan, Feb, and March, low vol allocation was substantially high in the portfolios, which helped safeguard in terms of the volatility which the markets went through. But in line with us increasing risk from March onwards, the low vol strategy allocation was also reduced. And what we have seen is a sharp bounce back in terms of the other active strategies or the momentum strategy in favor of which the allocation was increased by reducing the low vol allocation across our funds. So that's a framework which we adhere to and continue following. One update for investors on this side. We keep monitoring the overall allocations in the fund from time to time. So from a broader set of different advisors that we keep looking at any point of time, there could be some changes which may happen in the portfolio. In line with that, in the month of June, there was one change which we made. So Buoyant Capital, as an advisor, was added to the Optimus and Iconic funds. Now, Buoyant has an interesting long-term track record. So now they are working with Iconic and Optimus funds as advisors to our AIs. Buoyant has had an interesting track record. This is for Buoyant's own strategy, which we looked at when we identified Buoyant. Uh, Consistent track record over multiple years against various benchmarks. On the Iconic fund, so that's the portfolio positioning now with different advisors. We continue to have two passives in terms of the momentum and low vol strategy. On the advisor side, now Buoyant has got added to the portfolio. Inam, Unify, Abacus, and Valucus remain constant, as we earlier also had in the portfolio allocation to these four advisors. On the strategy breakup, Between March and June of this year, there has been quite a bit of a change which the fund has gone through. Uh, as we earlier saw that there was a risk which got added back to the fund. This was achieved by reducing allocation to the low vol strategy from around 20% plus as on March end. The low vol strategy weightage was reduced to around 10% as on June end. So there was quite a bit of a reduction which happened to this allocation. Low vol typically helps us play the volatile phase of the market. So if you look at this, the orientation or the role which we expect low vol to play is that in those volatile phases of the market, they give you a better margin of safety. Uh, Typically, low vol's behavior has been that they correct a lot more in the corrective phases of the market. Having seen that kind of a volatility play out in Jan and Feb, from March onwards, as our view became slightly more constructive on the market, the allocation to the low vol strategy was reduced, and the allocation to the active advisors went up in the portfolio. Now, that has really helped us across our funds, including Iconic. As we see across the last few months, the active advisors have really played out much better, where almost 3 out of the last 4 months, the active side has outperformed the passive, different strategies across the board. We continue to monitor this in terms of what the framework indicates. As the markets change, any allocation change required that will happen as per the framework. But so far, over the last 3 4 months, this change has enabled us to participate in the market uptake in a much better fashion, which is also reflective in terms of the performance for the fund, where over the last 3 months, we have been able to participate much better in terms of the upside which has come back in the market. If I look at the Iconic fund, the fund now completes 25 months uh, of live track record. Out of the 8 completed quarters, the fund has been able to outperform the benchmark on 7 out of those quarters. So we have had only one volatile period, which was that period when the entire market had a large correction. Apart from that, the fund has been able to beat the benchmark in 7 out of the 8 quarters. Moving on to an update on the Optimus funds. So on the Optimus, two strategies. Optimus Aggressive has an 80 equity, 20% fixed income oriented allocation. Optimus Moderate has a 50% equity, 50% fixed income oriented allocation. Across these strategies, there have been quite a few calls that we have taken over the last 12 odd months. Focusing on in terms of the overall asset allocation calls first. Here, between July and August 24, the framework indicated that we should book profits on the equity side. So in the Optimus Aggressive strategy, we were almost 84% versus 80%. And Optimus Moderate, we were around 54% equity deployed versus 50% strategic between July and August. As the framework indicated, in between those 2 months, we booked profit and brought the allocation down to the strategic levels in both the funds. So Optimus Aggressive equity was brought down to 80%. Optimus Moderate equity was brought down to around 48-50% of the portfolio. That helped us because 26 September onwards is when the market started correcting. So the framework indicated reducing the equity at the right point of a time. When the market corrected substantially, so Jan and Feb 25 is when the market saw the most volatile period in terms of the overall market breadth collapsing. That is when we were under deployed to equity. So almost 76% versus 80% in the aggressive fund and 45% versus 50% equity in the moderate strategy, which again helped us. Where being under deployed in equity in the volatile and corrective phase of the market helped us protect on the downside. And around March 2nd to 3rd week is when we started adding back to equity. So all this basis of framework which we adopt, all these three allocations were indicated in terms of when we make those changes. Uh, all these three is possibly we have got the timing right, where March 2nd or 3rd week was possibly a decent time to add back to equities, and when the allocation was brought back to almost the strategic levels across the funds. If I look at the Optimus equity, when the market corrected between the volatile period of Jan, Feb, and March, the first quarter of this calendar year, Optimus equity again, the correction was lower than what the average market saw. So that's the objective that we will probably want to target, that in a volatile phase, how we can be in line or slightly better than the market average. The equity portion achieved that objective. So on both the accounts, when the correction happened in the market between Jan and Feb, we were under deployed. So that worked in the fund's favor. The deployed equity portion also, the correction was lower than the overall average which the market saw. Moving on in terms of the other strategies that we have played out. So Y2 was replaced by Buoyant in the Optimus funds as well in June 25. And ASK was replaced by Abacus and ValueQuest in Feb of this year. So two action points on the equity side in terms of the different advisors on the funds which have happened in this calendar year. On the fixed income side as well, the portfolio continues to be a lot more broad-based. We continue to maintain a decent amount of allocation to REITs and InvITs across both the funds, which has really helped over the last 2 years. In fact, the REIT allocation has played out very well. The InvIT allocations, which we added further by taking allocation to two new InvITs over the last 6 to 9 months. So Bharat Highways InvIT and then Capital Infra. Again, both of them have played out well in the portfolio. So on the fixed income side, the portfolio remains a good mix of debt securities to good high quality bonds, plus allocation on the REIT and InvIT side. As the situation evolves, we continue to monitor any changes required on that side. We will look to implement. But the benign policy environment on the interest rate side continues to be supported of the REIT and InvIT allocation that we hold across the funds. That's a summary of all the calls which have played out well on the Optimus funds over the last 12 to 15 months. The fund continues, Optimus funds continue to deliver in terms of the overall investment objective that we have outlined. So around moderate and aggressive, these are the objectives that we have, and we continue to monitor and manage the funds in line with these parameters in mind. So that's an update from our side on the funds. Any questions from investors, you can please put it across in the chat box. Happy to take that. I request everyone to please put across your question in the chat box. One question that we have is for on the current allocations for the Iconic Fund. If I go back in terms of the breakup across different strategies in the fund, so on the extreme right are the allocations to various strategies as on June end, where the allocations to the active side have got increased over the last 3-4 months. The allocation on the passive side has gone down. Currently, the active side is around 71% of the fund. The passive is around 29. The breakup on the active side across various advisors is also outlined. Buoyant is a recent addition in terms of the advisors in the month of June. On the passive side, the large change has been in terms of the low vol allocation getting reduced from 20% plus to around 10% of the portfolio as on June end. Any other question? Would request investors to please put it in the chat box. There is a separate section for Q&A for every investor, so would request everyone to please use that to post your questions. There is one question in terms of the presentation. Sure. We will share a recording of this webinar, so you can get in touch with your relationship manager. The recording will be available in a couple of days. So any investor wanting to refer to the presentation, the recording will be made available. In terms of the overall funds, if I focus in terms of the Iconic Fund, over the last 12 months, I think the market has seen a complete cycle where till around September 24, the markets were in a bullish tone. If I look at around December 24 as well, the funds were doing much better in terms of the overall market. If I look at last year, last quarter, they're also in a corrective phase of the market. The fund outperformed the benchmark by almost 1.2. So the market corrected almost 10% between October to December 24 in that corrective phase also. The fund outperformed the benchmark by a decent margin, even in a falling market. But Jan and Feb is when the market saw a complete collapse in terms of the breadth, where not only the fund, across the market, every fund had a negative outcome as compared to Nifty, where We keep tracking all of the funds also, where it was the most volatile phase of the market. That is when even the iconic fund had an impact as compared to the benchmark. But over the last quarter, the fund has again bounced back. So that's what we will look at when we're looking at in terms of managing as a process, that relatively how there can be better outcomes. So 7 out of 8 quarters, the fund has been able to do much better than the benchmark. From a forward-looking positioning perspective, we remain constructive on the market at this point of a time. The valuation looks like uh, we are in a reasonable zone at this point of a time. We have gradually added risk back. Probably 6 months back, we were in a very different position where we were being more defensive on the fund setup. Now, as we have added risk back to the fund to participate or in the uptick in the equity markets, we continue to maintain the current stance. So, in terms of from a forward-looking view perspective, which is reflective in terms of the stance adopted in the fund, we continue to maintain a slightly higher allocation to the active strategies as we had probably 6 to 7 months back. So we remain constructive on the equity market at this point of time. There's one question in terms of the overall iconic fund. So we have around 4,500 crores total across both the funds. Both the funds continue to be a mirror image of each other. But yeah, overall, around 4,500 crores across these two funds that we have from various investors. There is one question in terms of the Nifty 50 earnings and trend going forward. So going back to what we shared, we believe that from a more macro perspective, the equity earnings look like they could be back to double digits going forward. I think this earnings quarter, which is underway, the markets are not expecting much. The numbers could be more like a single digit kind of a growth. But from a market expectation perspective, I think it's already priced in, where the market is expecting these earnings season to be possibly the bottom of the cycle. But some of the leading indicators, what they continue to indicate, where the next 2 to 4 quarters could be better in terms of the earnings momentum. We are expecting a double-digit kind of a growth in terms of the earnings. If I look at in terms of the leading indicators, like manufacturing and the services PMI, which are showing multi-month high, the monsoon season also looks like to be on track to be an above average monsoon season. So a lot of these factors coinciding, especially with the government focus coming back on the capex side, all of this should lead to a rebound in the earnings over the next 2 to 4 quarters. In line with that, the fund positioning remains in terms of to be more participative on the market rather than be more focused in terms of the defensive allocation. So that's how we are also positioning the funds across Optimus and Iconic. Any more questions? Would request investors to put it in the Q&A box. I think there are no more questions. Would like to thank everyone for taking your time to be here for the investor webinar. We'll again have this on a quarterly basis. So see you in the next quarterly webinar. Thanks a lot. Thank you.